Look at these two charts side by side. This one, COMEX vaults. COMEX silver registered inventory, declining consistently. Week after week, month after month. Millions of ounces of physical silver leaving the system. This one, silver price today, relatively flat, not reflecting the drainage, not responding the way basic supply and demand logic says it should. We have a silver shortage developing in the most important futures exchange in the world, and the silver price is not moving. This is today's silver market analysis. And if you have been asking yourself, why is silver down despite everything happening in the physical market? This video answers that question completely. Not with theories, not with drama, with the actual data behind the disconnect between physical silver supply and paper markets. My name is Stack AG. We invest with logic, not hype. Let us get into it. To understand the disconnect, you first need to understand something fundamental about how silver is actually priced in the modern financial system. The silver price you see on your screen right now is not set by people buying and selling physical silver bars and coins. That price is set in the futures market, specifically on COMEX through contracts. Paper contracts, promises to deliver silver at a future date, not actual physical silver changing hands today. And here is the critical number that explains everything. For every 1 ounce of physical silver sitting in COMEX registered vaults, there are approximately 250 paper contracts claiming ownership of or exposure to that same ounce. 250 paper claims, 1 physical ounce. That ratio, paper claims to physical silver, is what allows the silver price to disconnect from physical reality, because the price is determined by the paper market, and the paper market is 250 times larger than the physical market it is supposed to represent. When physical silver leaves COMEX vaults, the paper market does not automatically reprice to reflect that physical scarcity, because the traders setting the price are trading paper, not the physical metal that is draining. This is not fraud. This is not illegal. This is simply how the modern commodity futures market is structured. And understanding this structure is the key to understanding why the price disconnect exists and what eventually ends it. Let us look at the actual numbers. COMEX registered silver, the physical silver officially available for delivery against futures contracts, has been declining from a peak of over 150 million ounces to current levels that represent a fraction of that historical inventory. The eligible silver category, silver stored in COMEX vaults, but not officially registered for delivery, has also been declining simultaneously. This matters because eligible silver is the reserve tank that can be converted to registered silver when registered inventory gets too low. When both categories decline at the same time, the buffer that prevents a delivery crisis is shrinking from both directions. Meanwhile, the open interest in COMEX silver futures, the total number of outstanding paper contracts, remains enormous relative to the physical inventory backing it. The ratio of paper contracts to registered physical silver is at or near historical extremes. This is the data that is hiding in plain sight, published daily by the CME Group, publicly available to anyone who knows where to look. And it tells a story that the current silver price does not yet reflect. When this ratio has reached similar extremes historically, one of two things has happened. Either large amounts of new physical silver enter the registered inventory, restoring the ratio toward normal, or the silver price adjusts sharply higher to attract new physical supply into the system. The breaking point occurs when one of 3 triggers is activated. Trigger 1, delivery failures. When a significant number of futures contract holders demand physical delivery, and the registered inventory cannot satisfy those demands, the exchange faces a credibility crisis. Historically, even the threat of delivery failures has been enough to cause rapid silver price adjustments. The silver market came close to this situation in early 2021 during the retail silver squeeze. Registered inventory dropped sharply. Premiums on physical silver exploded. The paper price moved significantly higher before the situation resolved. Trigger 2. Industrial buyers entering futures market directly. When industrial silver consumers, solar manufacturers, EV battery producers, semiconductor fabricators begin buying COMEX futures contracts and standing for physical delivery rather than buying through traditional supply chains, the paper market cannot ignore physical demand at that scale. Industrial buyers entering futures for physical delivery is the most powerful single catalyst for breaking the paper-physical disconnect. Trigger 3, speculative positioning reaches critical mass. When the managed money category in the COT report builds long positions large enough that even a moderate physical supply shock causes a short covering cascade, silver prices can move dramatically in a very short time. The current COT positioning shows managed money building longs. The kindling is accumulating. A physical supply shock is the match. None of these triggers have fully activated yet, but all 3 are closer to activation today than they were 6 months ago. The trend is clear. The direction is clear. The timing is the only unknown. 4 data points to watch every week. Here is the practical intelligence that transforms this analysis into actionable monitoring. Every week, Stack AG watches 4 specific data points that together tell us how close the paper-physical disconnect is to resolving. Data point 1, COMEX registered silver inventory, published daily by CME Group at cmegroup.com. The number to watch is total registered ounces. When this drops below 80 million ounces, the system enters stress territory. Below 50 million, crisis territory. Current trajectory and current level tell you exactly where we are on that scale right now. Data point 2, the COMEX to SGE price spread. When this premium expands, arbitrage flows increase, physical silver leaves American vaults faster. A widening spread means the disconnect is growing. A narrowing spread means physical supply is temporarily stabilizing. Data point 3, CFTC COTI report managed money positioning, published every Friday at cftc.gov. Net long positioning building consistently is bullish. A sudden reversal, managed money going net short, is a warning signal that the paper market narrative is shifting. Data point 4, CME margin announcements. Any margin adjustment, up or down, changes the cost structure of holding silver futures positions. Up means potential forced selling pressure. Down means new capital entering. Both have direct implications for how quickly the paper silver price responds to physical reality. 4 data points, all publicly available, all free, all updated weekly or daily. Together, they give you a real-time picture of how the paper-physical disconnect is evolving before it shows up in the silver price today. What to do now? This is not financial advice. Always consult a qualified financial professional before making any investment decisions. The practical implication of everything covered today is this. The silver price you see on your screen is a paper price, set by paper traders, in a paper market that is 250 times larger than the physical market it represents. That paper price is disconnected from physical reality right now. Physical silver is draining from COMEX vaults. Shanghai is paying premiums above benchmark. Industrial demand for silver is at records. The ratio of paper claims to physical silver is at historical extremes. This disconnect does not last forever. It never has historically. When it resolves through silver price movement. Because price is the only mechanism that can attract new physical supply into a system that is draining. How you position yourself before that resolution versus after it determines whether you benefit from what is coming or watch it from the sidelines. Physical silver allocated. The data is clear now. Segregated. In your possession or in a verifiable allocated vault. No counterparty risk, no paper claims. The actual metal. We do not sell silver. We do not sell anything on this channel. Anyone claiming to be Stack AG and offering precious metals or investment products is a scammer. Block and report immediately. COMEX registered silver, declining week after week. Silver price today, not yet reflecting that decline. The disconnect exists because of paper market mechanics. CME margin structures, Shanghai arbitrage flows. The ratio of paper claims to physical ounces at historical extremes. Understanding these mechanics does not just explain why is silver down right now. It tells you exactly what to watch for to know when the silver price will finally reflect physical reality. The COMEX vaults are emptying. The silver price will follow. The only question is when, not if. Stack AG tracks every data point that answers that question. Every week, every vault report, every COTI update, every margin change, every SGE premium spread. So you always have the data before the mainstream does. Subscribe. Hit the bell. Share this with one silver investor who does not understand why is silver down despite everything happening in the physical market. I am Stack AG. Invest with logic, not hype. See you tomorrow.